Okay. Hello everyone and welcome to our post-budget webinar. We have both Claire and Greg with us today. Greg's going to run through a small presentation just with the highlights of the budget and a couple of facts and figures, and then we will aim to leave as much time as possible for your questions and answers section at the end. So any questions that you have, if you want to pop them over into the chat pod, which should be to the right of your screen, I'll pop a little nudge in there about halfway through as well, just to remind everyone to get questions in, and both advisors will go through those at the end for you, okay? The presentation we reckon will be about 20 minutes, so you should have quite a good amount of time left for those questions at the end. All right, Greg, I'll leave you to it.
Awesome. Welcome, everyone. Good morning, and hopefully everybody's sort of catching up on the going on in America after their elections yesterday. No doubt CNN or Sky News will be on in the background while we're talking. But be that as it may, the UK obviously had our own big news event last week, Wednesday, with the first Labour budget in 14 years. So the dust has settled quite a bit on what the Chancellor announced. So we're going to go through a few of the highlights and admittedly lowlights from that session. So I've got Claire on the as joining me. She's just nursing a bit of a scratchy throat, so I'll do most of the talking. But yeah, just sort of standard disclaimer at the top. This presentation is for information purposes only. Please do reach out to Claire, myself, Katrina, Mark, your advisors, if you would like to speak about these themes and announcements in greater detail. But yeah, from an introduction point of view, just a key overview of the changes in the 2024 autumn statement and their potential impacts on individuals, businesses, and public sectors. So the agenda outlined today, we're going to go through the autumn budget headlines. Then we're going to dip into a bit more detail into these following announcements. Obviously, pension, death benefits, and IHT being a big one. Income tax and NIC thresholds, private school fees, stamp duties and second homes, employer national insurance contributions, and carers and welfare support. So firstly, let's go through the headlines. So pensions and IHT from 6th of April 2027, most pension death benefits will be included in the estate for IHT purposes. Was sort of slipped in there by the Chancellor, which we had to sort of do a double take when she did announce that. CGT main rates increased to 18% for basic rate taxpayers, and then higher an additional rate, as well as trustees, 24% for disposals on or after 30th of October 2024. So the distinction here is that your disposals pre 29th of October 2024 will be different to post 30th of October 2024 within the same tax year. So that's key just to note there. Business asset disposal relief, disposals of business assets up to a lifetime allowance of £1 million. Then from 6th of April 2025, 14%, and then from 6th of April 2026 at 18%. Moving on, inheritance tax. The nil rate band is again frozen at £325,000 until April 2030. And the residence nil rate band is frozen at £175,000 until April 2030 as well. Those amounts, those bands have been in there for quite a while now. Obviously, the nil rate band has been there for decades at this point in time. Business property relief and agricultural property relief from April 2026. Only the first £1 million will get 100% relief on the combined value of agricultural and business property. And then for qualifying assets over £1 million, relief will be given at 50%, resulting in an effective rate of 20%. Reliefs will also be applied to shares not listed on recognized stock markets such as AIM shares or the alternative investment market shares. Further headlines: employers' national insurance. So the secondary earnings threshold has been reduced from £9,100 to £5,000, and that's been frozen until 6th of April 2028 and will be increased by Consumer Price Index thereafter. Employers 15% above the secondary earnings threshold, and under 21s above £50,270. Employment allowance allows employers with national insurance contribution bills of up to £100,000 in the previous tax year to deduct £5,000 from NIC bill. And then from 6th of April 2025, allowance being increased to £10,500 and a £100,000 threshold will be removed so that all employers will be eligible. So tax timetable, this is just a summary of the progression of the tax, certain allowances and tax rates over the years. Just to scroll to the main UK tax allowances. At this point in time, obviously, personal income tax allowance is still frozen at £12,570. I'll touch on that in a short while. So no changes to these allowances. Obviously, a big thing over the last few years is the CGT annual exemption has been gutted from a few tax years ago and will remain at 3%, £3,000. And yeah, as mentioned, personal allowance frozen until 2028. So, as I said at the top, the pension, death benefits, and IHT sort of largely slipped in there, but will have a massive consequence. So it's proposed from the 6th of April 2027, most pension death benefits will be included in the estate for IHT purposes. The government has opened consultation on the processes required to implement the changes, and responses must be in by the 22nd of January 2025. So the key distinction here is that it has been announced. It's just about how it will be implemented is what this consultation process will entail. So if the final legislation comes in as proposed, it will increase complexity in the death claim process, especially for the legal personal representatives of the deceased, many accessing pensions earlier than initially planned and at a greater level because of that fear. Change on how pensions are used for intergenerational wealth. That's obviously using pensions as an estate planning vehicle, which will have a knock-on effect to need to review of your inheritance tax mitigation strategies. So what are the proposals in this regard? So the pension scheme administrators will become liable for reporting and paying any inheritance tax due on unused pension funds and death benefits. All pension death benefits appear to be covered by this, apart from dependents' scheme pensions and charity lump sum death benefits. How a beneficiary accesses inherited benefits, lump sum or pension makes no difference for IHT. So moving on from pensions and IHT, obviously a massive announcement with regard to private school fees. It's the new VAT introduction of 20% on tuition and boarding fees starting from January 2025. It's the removal of charitable rate relief from April 2025. Private schools in England lose charitable rate relief on business rates. The purpose of this is to raise funds for state education initiatives, and the projected impact is higher tuition costs for private school parents, potential changes in school enrollment. Obviously, that will potentially send kids from private schools into the state-run schools as a result. Stamp duty on second homes. So there's a rate increase there, effective immediately. Stamp duty on second homes rises from 3% to 5%. The target audience of that is primarily landlords and buy-to-let investors. And on average, buyers will see an additional £7,000 in costs per property at current market rates. The rationale from a Labour government is to deter speculative property purchases and address housing affordability. Employer national insurance contribution increase. The increase in the NIC rate goes to 15% from April 2026. The support for small businesses, so employment allowance doubles to 10,500, aiding businesses with national insurance contributions liabilities under £100,000. And the impact, larger tax liabilities for mid-sized to large employers, support for smaller businesses, as I touched on in the headlines above. Then support for carers and welfare programs. So increase in carers allowance limit, weekly earnings limit raised to £181. Extended welfare support, household support fund and discretionary housing payments extended into 2025-2026. And the purpose of this is to target relief for financially vulnerable households and individuals needing caregiving assistance. So, summary of key impacts. So for individual taxpayers, it's going to result in higher tax bills through fiscal drag, obviously with the basic rate band being frozen up until 2028. Sorry, was that 2028 to 2030? Let me just double check here. 2028, if I'm not mistaken. Okay. So obviously through that fiscal drag, so through inflation, your pay package is going to rise, and with that static income tax rates, that means that you're going to be paying more tax as a result. Another key impact is pensions brought into estate for IHT. So as I mentioned, review of IHT mitigation strategies needed. Trusts will need to be discussed in greater detail, offshore bonds in greater detail as a result. Private school families increased costs due to VAT and business rate changes. Property investors, higher costs for second property acquisitions, and less of that speculative second property purchases. Employers, higher NIC obligations with support for small businesses. And as I mentioned, caregivers and vulnerable households, additional relief through raised allowance limits and extended funds. So those are sort of the highlights that I've sort of concentrated on in this. There's obviously the non-dom announcement and a few other announcements with regard to a few of the scandals, the infected blood scandal and also the post office scandal. But these are the sort of summary of the key aspects, key impacts that we've picked out. So I'm mindful that I've sort of whizzed through that. So we've got quite a bit of time for questions. So if anybody has any questions that they want to send over.
Lovely. Okay, so we actually had 2 questions get sent in during the week. Sure. Let's just quickly have a look at those. So you might have covered over them. We had, were there any new housing or property market measures in the budget that would affect property investors or homeowners?
So that was the rise in the stamp duty on second properties.
Yeah. From
3% to 5%.
Yeah, I wouldn't say there's any homeowners. However, obviously, council tax implications under Labour government. There will be changes to those for even your main home, but you may have a holiday home, not necessarily a property investor. But if it's not your primary principal residence, there are changes in council tax costs as well.
Okay, and then this one just says so capital gains tax and inheritance tax. How are these updates, and how will they affect my assets? So does this mean how will the update affect my assets?
So CGT, from a CGT point of view, that would affect your personal investment account. Your general investment account. And it'll depend on what type of taxpayer you are, basic or higher. So any disposals made after the 30th of October 2024 will be taxed at a rate of 18% and 24%, above £3,000, which is the exemption. So that will be a change from 10% and 20% respectively for basic and higher rate tax CGT before the 30th of October. Was there a second part to that question, Jess?
The IHT, was it the second part?
Yeah.
Yes. From an IHT point of view, they've frozen the null rate band and the main residence null rate band, and also with the announcement of bringing pensions into your estate, that means that there's likely going to be more assets tested for IHT at point of first death if you are single, and second death if you are married.
Yeah, I think pension nomination forms and where you're nominating your pension, in what proportions, really need to be considered by clients, by everyone, to direct your pension to, not only where you actually want it to be sent, but, how it's then split under, potential spousal exemptions and things like that. But yeah, you can also, one of the consultation factors on pensions is that your instructions to the trustees are currently non-binding, which, they have to be non-binding for the trustees to be outside of your estate. Because they're now inside of your estate, you can actually change your nominations to be binding instructions, so that there is no discretion, no discretion after your death, and no, consultation by pension scheme administrators and pension trustees as to what actually happens with your pension. So, once that consultation period is over, I think, that is one thing that really does need to be addressed by, pretty much everyone in the UK.
Lovely. And then we've also got, there was no change in TSC, tax-free cash of 25% for pension lump sums, so no need to rush and take this cash out.
Perfect question. Been asked this 100 times, I think, the last week or so. Each person, each personal situation is different. Obviously, your age has a factor, how much your pension is worth is a factor, because obviously pensions being within your estate for inheritance tax now, that 25%, the argument for not taking tax-free cash in lots of cases is that, point one is that pensions were outside of your estate. So, bringing that 25% into a taxable environment was the biggest driver not to do it. I am discussing this with lots of clients, so I'm sure we'll talk about this soon. But yes, there is still arguments to rush to get it out, but there's also still arguments not to. And obviously these changes aren't coming into effect until 2027. So yeah, definitely want to discuss over the next 18 months or so, with your advisors and family. I guess it's a wider family planning opportunity.
And then we've got this question. As a retired person, I have continued to make pension contributions largely as a protection against IHT. Now that pensions will be included as part of the state for IHT calculations, is it sensible to continue to make such pension contributions?
So I'll take this one. So it depends if you are younger than 75, because I would say that to continue making your pension contributions up until 75 means that you would continue to receive the basic rate tax relief on that pension contribution. So that would be a net contribution of 2,880 grossed up to 3,600 per annum. But as an IHT mitigation strategy, what I would say is to possibly use your gifting allowance. So your gifting allowance is £3,000 per tax year. You can carry forward the previous year's gifting allowance if you didn't use that. So you can possibly gift £6,000 in this tax year as a form of an IHT mitigation strategy. So I would also just say just contributing to a pension means that you can shield your funds from capital gains tax, which with the low CGT exemption at £3,000 means that there's likelihood that more money could be liable for CGT, and that's not the case when it's wrapped up in a pension.
Something also to consider on pension contributions are third-party contributions. So it's not something I've highly discussed in lots of detail before. But a third-party pension contribution is making a contribution to someone else's pension. They would receive their marginal rate of tax relief on that contribution, and the exemption could we could roll that as a gift out of normal expenditure, which could be very, very useful as a not only inheritance tax tool for you as an individual, but also a planning tax efficient opportunity for your future beneficiaries. But yeah, as I say, as Greg said as well, there's lots to that question. So yeah, I think the answer to every person will be slightly different.
Are there any effects on VCTs and EIS investments?
No. So yeah, no. So the VCT and EIS, the tax reliefs, have remained unchanged. Labour still do want to support, or say they want to support UK entrepreneurship, UK businesses, and this, the reliefs are offered by these are supported.
Is there a need to reevaluate pension allocations or consider alternative retirement saving options? Should I be looking to do something different from pension contributions if looking to pass on wealth to the kids?
So what I would say on that is, from an auto-enrollment point of view, there's no changes there. So the onus will still be on the individual to save for his or her retirement. And also with the sort of increases in state pension ages as we go into 2028 and 2048 means that the state pension as a form of income in retirement will be less and less prominent. So in terms of reevaluating pension allocations, I wouldn't make any drastic changes at this point in time. Obviously, it will be important to discuss it with your financial advisor specifically, but a continuation of that would, from a tax relief point of view, would be key, as those allowances have not been changed. So you can still contribute up to £60,000 or the equivalent of your earned income for each tax year with carry forward available. So to make those contributions into a tax incentivized position like a pension would be a beneficial way. And as Claire mentioned, in terms of passing wealth on to the kids, that fundamentally has changed, because obviously pensions are part of your estate, but making use of third-party contributions, gifting allowances, trust-based investments will need to come to the forefront to combat that.
Okay. It won't let me publish this question, but we've also had, what will the effects be on ISAs, from Jeffrey?
So no effects on ISAs at this point in time. Allowances are fixed at £20,000 for an adult ISA, £9,000 for a junior ISA. No changes. Obviously within your estate for IHT already. So no changes with ISAs at this stage.
The British ISA was completely scrapped, but that was scrapped before the budget. So that additional 5,000 that the Conservatives had proposed doesn't exist. So that's not there. And if you have done IHT, so inheritance tax planning, on your ISA, for example, using AIM style investments or an AIM portfolio, that exemption is still there. It's just at 50% of the relief. So essentially, now your ISA would be, if you passed away with an AIM ISA today, exempt. If you passed away with an AIM ISA next tax year, it would be taxed at 20% for inheritance tax, not 40%.
And then we also have from David, the government have talked pre-budget about changing or improving how pensions can be invested. Is there an indication on what this means and a timeline?
There is a wider review on pensions that is still ongoing, which, one of the reviews is, yes, is there a level of risk that can be taken in a pension? Do we need to, regulate what people are doing with their pensions? Do they need to impose restrictions on withdrawals or, minimum withdrawals, things like that? That is all still being done in the pension review, which, I expect that to be, a year project to involve, all stakeholders, as they call them, so providers, individuals, financial planners, pension administrators. They consult on all of that, which, I expect pensions to continually being reviewed in legislation, and I think that will come. I don't think it will be harsh on what pensions can invest in, because obviously SIPPs are very, very wide ranging. But I think there are additional changes to come with pensions, which big IHT being the first one.
And then from Derek, we had planned our retirement asset drawdown strategy to prioritise withdrawing first from ISAs and savings rather than pensions. How does this budget mean that this drawdown hierarchy changes?
So I would just say on that, it has changed, and I would have agreed with you on that strategy of utilising assets in your estate before pensions, which is out of your estate. I'd say obviously continue doing this until 2027 off the bat. But I would also just say this will come down to your income tax position. If you are at a stage where you might have to go up into the higher rate, then obviously utilising ISAs to get you over would be necessary. Obviously, if you want to keep your income tax position as a basic rate taxpayer, but that does need sort of more gaming out through cash flow modelling, through projections for the rest of your retirement.
And then we have from Simo, could you kindly explain the IHT on pension at first death and at second death?
Sure.
So on first death, so that would be covered by the spousal exemption. So that will go to in terms of the estate to your spouse, and then on second death, that's when the estate will need to be tested for inheritance tax. So anything above your allowances will then be levied 40% on those assets. Anything to add there, Claire?
No. So it's goes back to me advising everyone rethinks about where their pension is being nominated. You could, if you had a nomination to kids, siblings, unmarried, unmarried partner, that would be first death. But, it could be the right thing to do because, based on ages and how death benefits on pension work and inherited drawdowns, there could be, inheritance tax and then, future income tax liabilities for the beneficiary. So planning around those is, comes kind of hand in hand now rather than, having a nomination form and knowing that it was passed outside of the estate. So, very important factor.
And then we have from Neil, can you protect DC pensions from IHT for transfer to non-spousal partner?
I would say
that's probably just what I said. So no, nothing. So you can't transfer your pension in your life to anyone. That isn't an option. Your pension is yours, and on death, the spousal exemption is wholly reserved for spouses, civil partners. So that exemption, passing it across between spouses, is legally married civil partnered people. So unfortunately, if you have an unmarried partner, then you would not be able to get the spousal exemption.
And then we have from Roger, could unused pension be placed in trust for children or grandchildren to avoid IHT?
Another interesting question. So unused pension, obviously it's still yours. So while it's a pension, it's still yours. You cannot nominate in your lifetime that pension to a trust. You could think about over withdrawing, so taking additional drawdowns and using that as a strategy, to then give that additional drawdown out of your estate. However, it will be taxed in your name while you were alive. You can use trusts after death, but it depends how you want your pensions to be distributed. So pensions generally end up in inherited drawdowns. A trust is not a individual, so it cannot hold it cannot have a pension itself. So it would be distributed to trust as a lump sum, and that lump sum on a death after age 75 would be taxed at trust tax rates, which will always be the highest prevailing rate for an individual. So potential high tax burden on using trusts and pensions, but I wouldn't rule it out completely. It's it definitely still is there as an option, but yeah, it's changed.
We've got from David, is gifting allowance applicable to payments to a spouse?
No. So spousal transfers are not sort of down to any allowance, any gifting allowances. So you can make transfers to your spouse.
Okay. I think that's all of the questions we've had so far. Obviously, give you guys a couple more minutes to get a couple more in. Claire and Greg, is there anything that you think that people should be having in the forefront of their minds to kind of look to discuss with their advisors in the next kind of time period?
I would just say from my point of view, just to catch up on what the plan was and how that plan needs to change. As obviously we've been talking for 10 years plus with regard to pensions as an IHT planning vehicle on top of a retirement planning vehicle. So I would just say to check in with your advisor, just to check that the prevailing strategy is still suitable, or if changes need to be made.
We've also had from James, do you think the pension IHT will be here to stay or get reverted by the next government?
Fun question. I think in a changing government, so, if we expect Conservatives to come in 5 or 10 years, you may think this, your pension will die, you will die in the next government. It is a possibility. I think Conservatives would probably be quicker to reverse personal tax changes. So, potentially CGT rates, CGT allowances, drop employers' NI, and things like that would be at the top of their list before they change this. I think pensions and IHT, it's happened now. Is there a strong argument for another government to use it as a tool to, gain support? Maybe not, because it's not something that impacts the individual during their lifetime. Yes, it impacts generational wealth transfers. But I feel, the Conservative government would focus more on agricultural and business relief changes that have come in than they would on the pensions. But I've been wrong before, so so yes, I think it's possible, but I don't think it would be maximum. So,
Glenn, what is the max gifting allowance per annum?
There's lots of gifting allowances. So, there are gifting out of normal expenditure. You have a annual exempt amount, or an annual gifting allowance of £3,000 per tax year, which can be gifted. Gifting out of normal expenditure could be any amount. So it depends on your situation whether there is scope for the gifting out of normal expenditure. There's different allowances for weddings, things like that. So yes, a maximum gift allowance per annum is tricky. A maximum gift allowance in 7 years, if you were doing a chargeable lifetime transfer, is the nil rate band. For example, that is, and then there is no maximum. If you wanted to gift, £100,000, £10 million to someone, you could do it without an immediate tax charge. You could just transfer that money to someone, survive 7 years, and it's outside of your estate. So the maximum gifting allowance in each year is, it could be anything.
And then we have from Jeffrey, is there any mitigation measures at this stage?
I would assume that's for IHT purposes. The trust-based investment gifting into trust is still a relevant IHT mitigation strategy, as you are going to be gifting it into a separate vehicle that would be outside of your estate. Obviously, you would need to survive that 7-year period on gifts into trust above the nil rate band. But third-party contributions, Claire touched on, gifting allowances would making use of your gifting allowance would be further IHT strategies.
And then we have from Sam, from the budget report, section 31, there was talk of bringing in 605 tax via ISAs for 2026. How could that be possible?
I haven't read that specific part you're talking about. However, I believe it will be from the ISAs that hold AIM investments. So the ISA that holds an AIM portfolio would be exempt from inheritance tax because it gets the full 100% relief at the moment. When the rules change, it will be a 20% tax on all of those AIM shares, the value of that ISA for that person, which I imagine is where that 605 million would come in, because there has been, there is no change in ISA allowances, there's no change in ISA, taxation of the gains and income within the ISA, and that hasn't been done.
From an advisor perspective and market view, what was the thinking behind the pension IHT, especially now?
I would just say on that, it's a new government, new Labour government coming in to generate tax revenue, and there were quite a few different ways that were discussed and thrown out before the budget. This is one of the ways that they've decided on. From a pensions point of view, there have been lifetime allowances up to 1.8 million in the past. At the point of abolishment, it was at 1.073 million. So these things change, they evolve. Obviously, the lifetime allowance was abolished 2 years ago. So now bringing a measure like this in by putting pensions in one's estate will mean that there's potential that people will pass on less intergenerationally, so more tax to obviously collect through IHT.
Lovely. We don't actually have any more questions at the moment. I think we've got someone typing just now. Let's have a look. So from Gary, we have, I am aiming to take my pension from beginning of tax year 2025. I would like to draw the 25% out and pass to my 3 children equally. So can I gift it to them? And if I survive 7 years, they do not pay any tax.
So I assume that 25% is going to be the gift to your 3 children. So that would be brought into your estate at point of paying out of the tax-free cash. And then, yes, if you survive and you pay it over to your children, you survive for 7 years, then that will be removed from your estate for IHT purposes. So they don't pay any tax.
And then we've got from Jeffrey, this will encourage spending now at VAT, as VAT is 20%, not 40%. I think I can.
Yeah. That question I agree with. There's more incentive for people to bring money out of their pensions. There's pros and cons to all of it. But I agree with that statement because it's going to bring more money out of a pension wrapper into individuals' personal wealth. But yeah, I also think there's going to be more people drawing an income from the pension, which is in turn going to increase income tax receipts for HMRC, which I don't believe was considered in the budget, but it is being considered in the pension review that I mentioned earlier. So yeah, you are correct, and I agree.
Lovely. Okay, so yeah, last call for any questions. Meanwhile, I'll just explain to everyone that after this webinar, you will receive a copy of the recording and the slides from today's presentation. And we will send them out. Normally, we like to send them out within 24 hours. Just a note that with these webinars, whenever you sign up for the webinars, you add yourself to the email list. So even if you can't attend on the day, it is worth signing up to, because you will then receive a copy of the presentation and questions like this at the end of it, and the recording as well, that you can obviously use in your own time, or if you do have any questions off the back of that, you can obviously contact us, and I'm sure Claire or Greg or Kat or Mark are happy to go over anything off the back of them for you. We do have one last question from Roy. Could the 7-year rule be extended, for example, to 9 years? And if so, could this affect gifts from estate made this year?
They could do that, yes. If they implemented that change, and the gift, let's say the gift had been made 6 years ago and they made that change next year, so you would have been in year 7. If you died in year 9 and the rule was 10 years, yes, because inheritance tax legislation prevails at the point of your death, whatever the rule is at the point of your death would be the way your estate is assessed. So yes, business relief that's been, exempt from inheritance tax is now, will now be charged at 20%, potentially. AMISAs, as I said, that rule was in play. If whatever the rule is at your death will be the one that gets followed. So yes, this didn't get changed. There was big speculation that it was, but yeah, it's nice to see that it hasn't been. So the 7-year rule remains the 7-year rule.
Lovely. Okay, I think that has concluded all of the questions that have come through at the moment. But as mentioned, anything further that you think of, please do send our way, and someone can obviously have a look at that for you. I will be putting a small survey up, so if anyone has just got a couple of moments just to leave some feedback for us, I'm sure the guys will really appreciate it. And if there's a section at the bottom just to say that if there's anything that we've covered or you would like to be covered in further detail within these webinar sessions, please do leave a comment, and we can obviously look to try and schedule that in, because this is obviously for our clients to gain as much knowledge as possible. So do leave those comments. Otherwise, we will catch you at the next webinar.
Awesome. Thanks, everyone.